Hello, and welcome back to Fundamentals of Corporate Finance. I am Dr. Annette Moultrie, and we will continue with Chapter 6. However, this is Part 3 of Chapter 6. Now, Chapter 6 introduces bonds and applies our evaluation tools to analyze them. Essentially, bonds represent loans. When an investor purchases a bond from an issuer, they are essentially lending money to the bond issuer. Bond issuers are diverse, and they include both federal and local governments, which issue bonds to fund extended projects. Also, numerous companies issue bonds as a component of their debt strategy. So, like zero coupon bonds repay investors their face value upon maturity. Also, these bonds provide periodic coupon interest payments. Currently, financial markets trade two types of U.S. Treasury coupon securities, and they are Treasury notes and Treasury bonds, as you see here in this table. Treasury notes with original maturities ranging from 1 to 10 years, and you see the Treasury bonds with original maturities exceeding 10 years. The original maturity denotes the bond's term at its initial issuance. So the primary difference between Treasury bonds and Treasury notes lies in their respective maturities. Treasury bonds typically have longer original maturities, typically exceeding 10 years, while Treasury notes usually have original maturities ranging from 1 to 10 years. So in essence, Treasury bonds are long-term debt securities issued by the government, while Treasury notes are medium-term debt securities. And here you see in this table again, your Treasury notes and Treasury bonds. Now, while the return on a zero coupon bond stems from purchasing it at a discount to its face value, the return on a coupon bond comprises of two components. One is any variance between the purchase price and the face value, and two is regular coupon payments, or periodic coupon payments. So before determining the yield to maturity of a coupon bond, we must ascertain all its cash flows, encompassing the coupon interest payments and their payment schedule. So the next example that you'll see, which is on the next screen, example 6.3, is a problem which will illustrate this process that I'm talking about by converting a bond description into its corresponding cash flows. So here's the problem. Assume that it is May 16, 2023, and the U.S. Treasury has just issued securities with a May 2028 maturity of $1,000 par value and a 2.2% coupon rate with a semi-annual coupons. Since the original maturity is only 5 years, these would be called notes as opposed to bonds. The first coupon payment will be paid on November 16, 2023. That's 6 months from the issue date. So the question is, what cash flows will you receive if you hold this note until maturity? What cash flows will you receive if you hold this note until maturity? So the solution plan. The description of the note should be sufficient to determine all of its cash flows. The phrase May 2028 maturity, $1,000 par value, tells us that this is a note and a face value of $1,000, and 5 years to maturity. The phrase 2.2% coupon rate with semi-annual coupons tells us that the note pays a total of 2.2% of its face value each year in 2 equal semi-annual installments. Finally, we know that the first coupon is paid on November 16, 2023. To execute, the face value of this note is $1,000. Because this note pays coupons semi-annually, using the 6.1 equation, you can compute that you will receive a coupon payment every 6 months of $11. That is the formula CPN equal $1,000 times the 2.2% divided by 2, meaning twice a year, is $11. And here you see the timeline that is based on a 6-month period, and there are a total of 10 cash flows. Note that the last payment occurs 5 years, that's 10 6-month periods from now, and is composed of both a coupon payment of $11 and the face value payment of $1,000. To evaluate, since a note is just a package of cash flows, we need to know those cash flows in order to value the note. That's why the description of the note contains all of the information we would need to construct its cash flow timeline. Here we have another problem. Example 6.3a, the cash flows of a coupon bond or a note. Assume that it is January 15, 2025, and the U.S. Treasury has just issued securities with January 15th, 2034 maturity, a $1,000 par value, and a 3% coupon rate with a semi-annual coupons. Since the original maturity is only 9 years, these would be called notes as opposed to bonds. The first coupon payment will be paid on July 15th, 2025. What cash flows will you receive if you hold this note until maturity? The solution plan is the description of the note should be sufficient to determine all of its cash flows. The phrase January 2034 maturity, $1,000 par value, tells us that this is a note with a face value of $1,000 and 9 years to maturity. The phrase 3% coupon rate and semi-annual coupons tells us that the note pays a total of 3% of its face value each year in 2 equal semi-annual installments. Finally, we know that the first coupon is paid on July 15th, 2025. The first coupon is paid on July 15th, 2025. Here you see there's a timeline. Let's execute. The face value of this note is $1,000. Because this note pays coupons semi-annually from equation 6.1, you will receive a coupon payment every 6 months of $15. That's the CPN equal $1,000 times the 3% divided by 2 gives you $15. Here is the timeline that you see here. It is based on a 6-month period, and there are a total of 18 cash flows. Note that the last payment occurs 9 years, that's 18 6-month periods from now, and is composed of both a coupon payment of $15 and the face value payment of $1,000. To evaluate, since a note is just a package of cash flows, we need to know those cash flows in order to value the note. That's why the description of the note contains all of the information we would need to construct its cash flow timeline. Yield to maturity of a coupon. So after establishing the cash flows of the coupon bond, we can calculate its yield to maturity based on its market price. Now, remember, the yield to maturity represents the rate of return earned by investing in the bond and retaining it until maturity. Now, this investment has the cash flows that you see that is shown in this timeline on the screen, right? The yield to maturity of the bond is the unique discount rate that makes the present value of the bond's future cash flows equal to its current market price. While zero coupon bonds have only two cash flows, coupon bonds involve multiple cash flows, adding complexity to the yield to maturity computation. Here you see in the timeline, the coupon payments form an annuity, and the yield to maturity, denoted as that Y, you see the Y, satisfies the equation on the next screen. So as you can see, unlike the zero coupon bonds, there is not a straightforward formula to directly compute the yield to maturity. Instead, we resort to methods like trial and error, where we try various values of Y until we find the one that equates the present value of a bond's payment to its price. However, this process can be quite laborious. More commonly, financial calculators or Excel spreadsheets we would have to use. It's much easier to do it that way. And here we have a problem. Consider the 5-year $1,000 bond with a 2.2% coupon rate and semi-annual coupons described in example 6.3. If this bond is currently trading for a price of $963.11, what is the bond's yield to maturity? What is the bond's yield to maturity? Well, we work up the bond's cash flows in example 6.3. From the cash flow timeline, we can see that the bond consists of an annuity of 10 payments of $11 paid every 6 months and one lump sum payment of $1,000 in 5 years. That's in 10 6-month period. We can use equation 6.3 to solve for the yield to maturity. However, we must use 6 month intervals consistently throughout the equation. So to execute, because the bond has 10 remaining coupon payments, we compute its yield, Y, by solving equation 6.3 for this bond. And here you see the formula. We can solve it by trial and error, a financial calculator, or a spreadsheet. To use a financial calculator, we enter the price we pay as a negative number for the PV, right? It is a cash flow, the coupon payments as PMT, and the bond's par value as its FV. Finally, we enter the number of coupon payments remaining, which is 10, as the number, as N, which is number. Okay, here you see the illustration of the use of a financial calculator. And then you have the formula that you would use for the Excel with the Excel spreadsheet. Therefore, Y equal 1.5% because the bond pays coupons semi-annually. This yield is for a 6-month period. We convert it to a APR by multiplying by the number of coupon payments per year. Thus, the bond has a yield to maturity equal to a 3% APR with semi-annual compounding. Let's evaluate. As the equation shows, the yield to maturity is the discount rate that equates the present value of the bond's cash flows with its price. Note that the YMT is higher than the coupon rate and the price is lower than the par value. We will discuss why in the next section. However, I must stop with this video and continue with part 4, where we will start with a problem. Thank you. See you in the next video.